Well, my next guest is one of the most revered market strategists on the street, and the title of his most recent client note is Top of Mind, Gaming the Game of Thrones. In it, at the top, he mentions options convexity as being valuable. And I know not everyone is familiar with convexity, so I'm going to use this from Simplify to help explain it to you. Protection, it has a dual purpose. On the protection side, downside convexity is a powerful way to protect capital gains against deep market drawdowns. It can also be deployed either strategically or tactically. Also, from a performance side, upside convexity is beneficial for those investors who don't want to miss out on the biggest of market moves. Julian Emanuel joins us right now. He's managing, well, you've got a long title. Can I read, do I have to read all of it?
Nah, choose what you like.
Chief Equity and Quantitative Strategy Chief at Evercore ISI. Thanks for joining us.
Thank you.
So I thought it was important to explain to the audience because it's not a term everyone necessarily understands, but it sounds pretty intriguing that I've got some protection, but I'm also ready for a big upside rip.
So convexity is a strategy that you want exactly for a day like today, when people are uncomfortable, they're nervous, their emotions are taking over. And when you own convexity, you take the emotion out of it, because we both know, having done this for a little while, you and I, that investors make their biggest mistakes when they get emotional about their holdings. So if you own some option convexity, whether to hedge the downside or if we get into a situation where there's a melt up into the upside, you're able to participate on the one hand, you're able to protect yourself on the other hand, and what you're able to do, particularly on the downside, is do what has been working for the last 40 years, buy the dip. Buy the dip. And everyone likes to buy the dip, right? And especially in hindsight. In the middle of it, it makes it easier when you've got a strategy in place. That's right.
And your note, you published, it was October 13th, so, you know, during election season, that could be, feels like a long time ago, but the polls and the betting markets were sort of showing an increase since then, increasing the odds of maybe a GOP sweep. And it feels like everyone on Wall Street is okay with the outcome except a sweep by either party. What is it about one party controlling all the levers of government that worries Wall Street?
So it's interesting because that view is actually contrary to 100 years of market history. You go back and unified government outperforms divided government by almost 3% per year over 100 years. This time is a little different. We all know how divided the two sides are, right. And what both sides don't want is to see the extremes in the policies that make them uncomfortable on either side. And if you have gridlock, chances are we don't get any of those extremes.
Here's what I find, though, really intriguing, because the last 3.5 years have been amazing for corporate America. You know, I mean, all the Washington largesse that a lot of people complain about, trillions of dollars, it goes into corporate coffers. And those corporate coffers, it goes to the bottom line. And the bottom line helps to drive the stock market higher. So the 1% have gotten wealthier. Stock market holders have gotten wealthier. And listen, I understand ultimately the ramifications of it, but I'm just really shocked that some people still complain about gridlock. You know, when they know that the open checkbook seems to be really great for the stock market.
Well, and again, that goes back to that 100 years, because when you have unified government, they tend to spend more, and that tends to be better for the economy, better for the stock market. The reason it's a little bit different this time, perhaps, is because there's a discomfort with the level of the budget deficit, where interest rates are, and we've only seen it from time to time, but every once in a while, the market just gets queasy with that. And I think the thought is we want to just sort of let the landing take care of itself. And the Fed is helping us out in that respect without really going, you know, too much into deficit spending.
Are you in the hard, soft, or no landing camp?
We're in the soft landing.
So speaking of the election, when people come on and tell me that they're anxious about the election, I don't think they're anxious about the election. I think what they're anxious about, and you kind of pointed it out, a contested election. So a lightly contested election like we had in 2020, the market goes up. Highly contested, the hanging chads, the market was shellacked pretty good. And just listening to even both sides, to be quite honest with you, there's going to be some anger out there. Who knows when they'll finish the tally? One side's going to be extremely upset. We know it's going to be contested, but to what degree could impact the market?
Well, again, it just comes down to, as you pointed out, the degree, the length of time. But on a positive, We've already seen that motion picture. We saw it for a month in 2000,
Right.
which was definitely damaging to the markets at a time when consumer sentiment was starting to weaken anyway, and then you got a recession in '01. Consumer sentiment hasn't weakened yet here. So if you get something along the lines of what you saw in 2020, if we have a result that we have confidence in say it was 4 days in 2020, the market is likely going to be able to shake that off.
Well, and you're being modest now because I think you said if we get a lightly contested, we started the theme of the show was melt up. You're in the melt up camp. If we have an election after a few days, it's accepted and we move on. Melt up for the stock market?
So very interesting. When we got to Labor Day, we wanted to do some work about how the polls, being as close as they were at that time, what that said about the stock market. And instead, what we found out was when the stock market was up double digits on Labor Day, which it was, 6 out of 6 presidential elections, it always finished higher, 6 out of 6 times on December 31st. That, to us, in an uncontested election, is the recipe for a melt-up, because what you get is a lot of active managers having to participate in the performance chase.
And I think a major firm last week, I think it was Goldman's trading desk, said, listen, the institutional folks have missed this. They're the ones chasing this market, to your point. So lucky 7, let's root for that. I was checking out so Evercore's forecast. So your PE ratios, 4 PE ratios for the year 23, trailing 25. How much longer can this market trade at these sort of levels? I mean, at some point, there's a more sane, historic price-to-earnings ratio set in.
So there are a number of ways that this can end, right? But the fact is, when you talk about bull markets ending, it usually takes speculative fever, kind of what we saw in year 2000 in the top, or it takes a recession. We don't see either of those. So actually, when you've been as expensive as you are now, that can persist for 18 months to 2 years, and we're not even a year into it. We're not saying we're going to go massively higher. We need to see the earnings, but we think we will.
And you have another table in there that's fantastic, too, that just shows over the years just higher PEs and higher PEs, right? Here it is. So when we average it out, it's one thing, but over the years, they've gotten progressively higher and higher, you know, from 11, 12, 13, 16 to 18, 21. So before I let you go, this is fantastic stuff, by the way, Julian. Gaming the Game of Thrones, the sectors that you're looking at, I guess is sort of a barbell type of approach here. For the Fed cuts, technology, communication services, small caps, the subsectors, software and biotech, and then the barbell on the other side of that, consumer staples and healthcare. Healthcare has been really acting really ugly lately, though. But this is more, would that be more of a hedge? You wouldn't have these in equal weights within the portfolio, would you?
Well, you actually wouldn't. And the reason that you would is because, you know, think about the offense, right? Infotech has been, you know, a very strong sector. Small caps have had good times and bad times, but actually, you know, if we get that soft landing, they are likely going to outperform strongly. Now, with a soft landing, you also get these growth scares every now and then, and that's where the defensive sectors help cushion the portfolio so you can buy the dip instead of being frightened of it.
Great stuff. Really appreciate it.
Thanks very much.
Fantastic work.